think I'd like to start with one that actually was sent through very early on in this episode of Southbank Live. This is from Vincent. Good evening, gents. Good evening, Vincent. Akhil, have we seen the market bottom yet? And when will it be time to start buying precious metals? So yes, in terms of the market bottom, I'm assuming Vincent is referring to the stock market. But Akhil, enlighten us. Have we seen, now that we've seen the mid-cycle slowdown during the COVID years, which will have hopefully ended by now, have we seen the market bottom?
Yeah, we're not going to go below that low, that's for sure. I don't know if they're referring to the sell-off that the US has seen in the last few days. That I think markets might retrace a little bit. I think 2022 will be a fairly turbulent year, actually, politically, economically, because there's all this sort of question mark about the trajectory of monetary policy and support for economies. And in fact, there's another cycle I look at, decade cycle, and this part of the decade tends to be fairly turbulent. So a lot of reasons why maybe there might be a lower low to where we are now this year, but it's certainly not going to be where we got to in March 2020, in my view. Sorry, was that the question, or was it something else?
Secondly, is on precious metals, so on the commodity cycle again. Because I know you're not massively precious metals.
Is that a gold bug kind of question? Should we sell everything and buy gold?
Leave us alone.
I've never particularly been a big proponent of gold, other than as a commodity that rises with long-term commodity prices. And since I've said that we are in the upside of a long cycle, so commodity prices will do well in the 2020s. I don't think gold will be the best. Personally, I think the ones most exposed to the economy, so industrial metals and things like lithium, which are clearly where the economy is going, so much more technology based. Those are the areas where you should be focusing your commodity investment. But gold could be part of that. Where gold comes into its own is when you get close to the peak, and then you get a sort of a concern about the overall existence of the financial system, and you very much get those concerns after the peak of the cycle, and gold tends to do very well in those years.
Do you not reckon that during the outlandish phase in 2 years' time, where everyone's making so much money that they start acting irrationally, you don't think there's going to be a lot of bling on show? Maybe it'll be a fashion to get all your teeth removed and have them, gold fangs instead or something.
Yeah, but there'll be all of that, and there'll be lavish. Actually, maybe one of the markers of the outlandish behavior is very, very lavish Indian weddings. They tend to be extravagant affairs. And a lot of bling on show. So you might hear some celebrities had the biggest wedding in world history, or something as a sign that things are really kind of going over the top.
That's interesting. I've never heard of weddings used as a top indicator, but I'm definitely going to hold on to that one big time.
There's all sorts of things. You could say. I think I wrote about this a while ago. Fancy yoga pants. The share price of Lululemon or something. That
right.
People that clearly have money to spend on £50 yoga trousers.
See, this is one of the things where I think the outlandish behavior is already here, Akhil. I can't tell when we get into the truly outlandish phase.
But what are you basing that on what's going on with NFTs and other things like that?
This brings us. I think we should delve into that very much, but in a little bit. There are a couple more questions I'd like to get done first, and then we'll get straight into that. This one is from Joseph. Asks a very shrewd question, I would say. Do you think that QE and other easing tools from governments to deal with the global financial crisis and COVID will affect the length of your proposed cycle? So can your cycle not be pushed off course and delayed or extended or postponed or otherwise disrupted by government actions on the policy side, on monetary policy?
Look, it's a good question. The short answer is no. Government is a player within the system, and they respond to signals in the same way the private sector does, and they all together deliver historically cycles of very consistent 18 or so years, 18 to 19 years. Now, something that is very apparent now is that governments are much more willing to intervene in capital markets compared to previous cycles. And so you tend to find that the crash is very sharp but relatively short. So what might have been a crash that lasts sort of several months tends to take place in several weeks. And some of that is because governments are, very willing to open the monetary spigots. So you tend to, you might get that kind of thing at play. Doesn't mean that the underlying problems have been solved, but for example, in the stock market, you might get quite a quick recovery compared to historically. The other thing I'd like to point out is the example from 100 years ago, so the Roaring Twenties. I think one of the questions related to that as well.
Yep.
So the peak of the land cycle, and this is again another reason why people really need to focus on land, but no one does. The peak of the real estate cycle was in 1926, and that is when house prices in the US effectively peaked. But what happened then was that the UK had gone back on the gold standard, ridiculous decision in my view, and the US, to facilitate that, had to lower interest rates. So money coming out of the property market with lower interest rates pushed commercial real estate and also the US stock market into two of their biggest years. And so even though the economy was getting weaker and weaker, at least on the basis of the stock market, you had two very good years. And then of course, because you had two very good years, it came down and it didn't stop falling until 1932. So you wanted to be out. And actually, even Ben Graham, so the father of value investing, got caught up in that sort of mania of the late 20s. And actually, he was told to sell in 1930 when the market had come down 25%. He was told to sell his fund, his managing fund on behalf of other investors, and he didn't do it. So he lost a bit more than 25% in the early 30s, and then wrote his book about value investing.
Yeah. Funny how things turn out. I think to answer this chap's question, ultimately, when it comes to monetary easing, in the case of the 20s, the cycle should have ended. The market should have sensed that the party was over, 3 years earlier, ultimately. But government action in this case, with I think it was Benjamin Strong at the Federal Reserve, which back then was a completely different institution, ended up punting it even further, and that's why, and it became this incredible speculative frenzy. What was already a really heated market just went into overdrive. If we're getting to outlandish behavior in 2 years, and then we get outlandish behavior for 2 years, could it be that there is government intervention to keep the party going, and it just becomes even more extreme for a little longer, maybe 2 more years, before finally everything comes falling down?
The one rule that is if you've invested in the markets for any length of time is that markets never make things easy for you. And so yes, you could get something like that. You might find that actually property investments are not doing well, and in fact doing in some cases very badly. So like investors in Florida in the 1920s, for example. But in certain parts of the market, things look rosy, but they're not necessarily. And it's liable to turn around very quickly when it does happen, and you can guarantee that you won't necessarily be looking at the right things when that happens.
Right, and we shall get back to a few more questions in a little bit. It is great to see so many from the chat. Very lively chat this evening. Arthur Schopenhauer saying, "How about a war with Russia?" Well, how about it? How about it, Arthur? Just trying to imagine the man himself saying that, which would be quite something. There is a couple of things I'd like to dwell on when it comes to what we're seeing in the news recently, and whether or not this alludes somewhat to the land cycle that is sort of shifting beneath our feet, which people aren't quite noticing. Over the past 2 years, we've got all this stuff about a new normal. People are going to be working completely differently, so the rules have changed. We can't expect commercial real estate to deliver the way it did. And on that note, I would like to bring up an article from The Economist that you forwarded in, Akhil. This was taking a look at labs, the land upon which labs are created has seen an enormous boom over the past couple of years. This is Science and Technology Lifts the Gloom for Property Investors. Very interesting stats in that piece, looking at, I think it's the Singaporean Sovereign Wealth Fund, which recently bought a 40% stake in, I think it's a science park near Magdalen College in Oxford. They paid 10 times what it was worth 5 years ago. And all over the place, you're seeing commercial real estate being, people trying to alter it so you can build labs on it for all this biotech development and things like that. And it's one of those things where you wonder, well, it makes you see how land is still in enormous demand, even if what we traditionally would have associated its use as has changed somewhat. Even though everyone is saying with the world has changed so much, the value of land hasn't really. There's always something that some people want to do with it. Akhil, any thoughts on that you'd like to add?
Well, a couple of things. So commercial real estate tends to do much better in the second half than the first half. So it's more linked to economic growth and general kind of positive outlook and so on. And yeah, I mean, as you pointed out, the way we do business, the sectors of the economy that are dominant and so on are always changing, and therefore that changes the nature of the type of real estate and where it's located each time. And it's wherever it's located is where all the kind of money goes in and where the speculation ultimately goes. So if this trend continues, and I'm not enough of a scientist to know, if you can speculate in building labs, but if they're lucrative and if there's always there is the possibility that because we're tracking all these things that there'll be an annual COVID jab that we take, and it needs to be innovated, and so there's a possibility of making money. So people will throw up labs all over the place, and because a lot of it is done on the basis of technology and computing power as opposed to finding dead viruses and incubating them and so on. You could well see something like that, sort of speculative, well connected to the internet, but maybe in the middle of a northern English town or something, and that's where businesses will relocate and prices will go up. So there's always going to be something new. At the start of a cycle, it's not always easy to predict. We don't really know what kind of businesses are going to be created out of 5G, for example, but it's going to fundamentally shake up how we do business, I'd imagine, in the next sort of decade. So that will throw up new demands and so on.
Right. It's one of those things where, new waves of technology, they fit into your cycle to some degree, right? In terms of new technical innovation, unlocking new speculative booms, that it ties in quite well, right?
It does. I mean, so the behavior tends to speculation, and it speculates in the areas that are doing well. And I think Joseph Schumpeter was talked about creative destruction. I mean, I think he was talking about the general process of creative destruction, whereas actually what happens at the end of the cycle is everything starts to crash and gets destroyed, and the things that sort of emerge first from that are powered by the new sort of technology, the new direction in which the economy is going. So it was no coincidence that the smartphone rolled out very quickly after 2009. I mean, I know it was announced in 2007, but after 2009, and at the same time when everyone became connected to 4G. And lo and behold, all these new businesses that have become enormously valuable since then have been essentially powered by that technology. So technology does take the new cycle forward. What you do, and wasn't planning to talk about this, but what you tend to find the second half of the cycle is that technology doesn't do quite as well because it's more speculative, and so it's really led by house building and banking and infrastructure and construction stocks.
That's interesting. So we shouldn't be looking to technology quite so much in the second half over this next 7-year period.
Not
in
the way that not for the enormous outperformance that we've seen in the first half of the cycle between after 2011.
Right.
Now there's one caveat to that. I mean, it's not beyond the realms of possibility that you get Apple mortgages and you can order a modular house on Amazon. And so if they get into the real estate game, then of course that sort of changes, at least in a nominal way, it changes the thesis, but it's not really changing the thesis. Actually, they're becoming real estate speculative. They're seeing basically where the money is being made, and it's made in speculating in real estate in the second half of the cycle.
Very interesting on the technology side. I guess we'll have to wait to see, in the crash years, what comes out of that and what will ignite the flames of the next cycle to come. But I think we should discuss on the kind of technologies which may bring the cycle to a close. And you have alluded a little bit to digital real estate and where this ties in here. Vincent asks, how does speculation in NFTs and virtual property fit into the cycle? And could this be the center of the melt-up in the final 2 years? Very good question, Vincent. Thank you for that. Akhil, when people are buying huge amounts of virtual land in places like Decentraland and the Sandbox, you can buy acres of this stuff. It doesn't exist in the real world, but you can buy it, you can speculate on it, you can build things on it, indeed. Is this going to be the grand finale of this cycle? It's not even real land anymore. It's fake land.
Well, where people gather and exchange and do things together, I mean, that's land, so it can be virtual, but it doesn't replace physical land because you've got to be located somewhere. Yes, sorry, I wouldn't say the finale. I mean, it's whatever most people are doing. So if you have, a few, if not everyone is entering kind of virtual reality in Decentraland, if they're using other platforms, it might not just be one particular thing, but the point is well made. There will be general speculation in virtual real estate for sure, because we've already seen the first signs of it, and it's only really just getting started. And we don't use Decentraland in the way that we will probably in a few years' time. I would point out though that we might talk about being able to see Decentraland virtually, and it kind of looks like land, and so it kind of it makes it a bit more relatable. But the internet itself is digital real estate. It's this vast new continent that is effectively colonized by a small number of enormously powerful, to a certain extent, increasingly appear somewhat nefarious platforms, and that is effectively real estate in the virtual world. And the value of that real estate is not down ultimately to, it's somewhat down to the investments they've made, but actually it's the presence of everyone connected to the internet on very fast mobile devices, and or not necessarily just mobile devices, which is a function of public investment mostly. So this is kind of why such companies are so valuable. It's a new form of real estate for an internet age.
Very interesting. Could you expand a little on that and what your thoughts are on the current environment for digital real estate, which in this case is just NFTs of virtual areas, because this gets very easily dismissed. Decentraland itself, which has the Mana token, I believe, has been around for a long time. I remember it in 2017 during the last crypto cycle. It's still around now, but it's blown up a lot. There's actually another Economist article which featured, which I think we could bring up here, on virtual property prices. Well, let's see, virtual property prices are going through the roof. And this was somebody at The Economist noting how you could buy the Eiffel Tower and the Taj Mahal for, I believe it's $200,000 and $400,000. Though the people who originally bought them only bought them for $400 just a few years ago in I think this is Legacy, one of the it's a super world. Then this is the virtual land in which these kind of transactions are taking place, where people are recreating physical places in a virtual environment. Now, this kind of thing has been around for a while. People were playing Second Life when I was still at school, which was just a big MMO game. Why is this different? And is there genuinely any? I mean, a lot of people will say this is all just a joke, Akhil, and this is just ridiculous speculation. These are people buying Beanie Babies for ridiculous amounts of money. What are your thoughts on this as an actual item of value that has utility?
I mean, good question. So I don't know. I'm not an expert in NFTs and where it's all going. I probably should be, but I need to learn a bit more about it. So owning a fraction of a digital asset is invites speculation. Invites speculation over nonsense at the moment, sort of pictures of dogs and other things. But once you create fractional ownership of underlying assets like bits of Monaco apartment, and so on, which gives you the right to earn part of the rent of that. And if that is because that is fundamentally a scarce asset, there's only so many fractions of that same Monaco apartment that can be traded.
Yeah.
You can start to see these virtual portfolios, and then you can start to see banks creating credit against that. It changes the entire pricing mechanism of real estate in the real world. As a result, people's behavior in terms of buying and selling houses. I mean, you might move from your central London flat into where are you, in Derbyshire, into the middle of Derbyshire, but you might retain ownership of part of your flat. You don't have to sell the whole thing, for example. You can kind of start to see behaviors which will fundamentally reshape the nature of speculation, and that I do think is potentially where it's going to go. So NFTs will definitely be part of that, if that is the way to secure title to bits of real estate. Bits of artwork. You always get speculation in artwork every real estate cycle. In fact, the record for auctions of the masters, the record is always set in a couple of years before the peak. So Van Gogh or Picasso or whatever. You might see it now on actually, to be fair, on a smaller scale with speculation and digital art. But that in itself is not enough to bring the crash. It's got to be banking related and to do with more fundamental real estate.
Indeed. For I believe it was when Lehman Brothers was going bust. At the very same time, Damien Hirst was making a boatload of money, and he had, in something that was very unusual for the art world, he had actually bypassed the art dealers and gone to the auction houses directly, which is seen as very not to be done. This is very much a very arrogant thing to do. But of course, he saved himself a huge amount of money, and that occurred while Lehman Brothers was going bust. And he made an awful. It was record-breaking sale, etc., etc., etc. And that did coincide very well. So I guess we should also be keeping an eye on the art market during this period. I guess with the on the note of crazy things that are going to happen in the last 2 years of the cycle, it does feel like it could very easily be in speculation in the NFT space, or speculation in digital land. We did get a question saying, a comment saying that Akhil, your property portfolio must be absolutely enormous given your expertise on this. In terms of where you're looking on a much more practical basis, or not more practical, but less speculative than something like NFTs, etc., etc. I mean, where would you be looking? How should the everyman investor be looking to take advantage of the cycle?
So the pattern tends to be, and this is not unique to this cycle, is that the center of cities, the most important cities or regions in a country, tend to have a much stronger, from a property point of view, first half of the cycle. It takes much longer for peripheral regions or secondary, tertiary cities, or the edges of suburbs, etc., to recover out of the previous crash. And so you get outperformance of the center. Second half of the cycle, that pattern is reversed. So as people get increasingly priced out of the center of the city or the main city, they look for cheaper property and they go to secondary and tertiary cities. And businesses and things follow. So, and we're certainly seeing that this cycle. We're seeing it in the UK, we're seeing it in Australia, we're seeing it in the US, we're actually seeing it all over the place. And so if you were a property developer or investor, that's the sort of pattern that I would follow. Of course, if you are like me, a sort of fairly busy, full-time, gainfully employed sort of person, you don't really have a huge amount of time to try and identify a great spot in, say, Sheffield or Leeds or wherever, which is going to be the next property hotspot. So it really depends on your circumstances. But if you're following the property market, that's kind of the way that I would do it.
Right. I think that answers a question from Rano saying, will London property also perform well in the second part of the cycle?
Well, it will perform well. It will perform well. It just won't, you'll see much greater gains in percentage terms in a place like Northern Ireland and maybe Edinburgh or something than you will in London.
Yeah, I was in Belfast recently, and I must say the property prices there were incredibly alluring relative to London prices. You can get an awful lot more.
That also answers the question about the size of my property portfolio, because I am based in London, and even for someone who, I like to think I know what I'm talking about, it doesn't mean that you necessarily have the capital to build an enormous London property portfolio, I'm sorry to say.
On the on topic of land, and we do get a question on just joined, guys. Has London property reached its peak? reached its peak. So in the second half, it still expands, right? It still grows further, but it's just not as much, right?
Yeah. So no, we've not reached the peak.
Right.
Now, sorry, I just should say that property prices are talked about on average. I mean, it doesn't mean to say that absolutely every property in every area in London is going to go up for the next sort of 4 to 5 years. You have, property is fundamentally locational assets. You have to kind of buy a good asset, in a good location that people want to live in, at good quality, etc. Doesn't have any issues with it. But yeah, so the general point is that we haven't seen the peak in London property prices.
Do get a question from a chap who is looking to sell a rather large estate in Cornwall. Of course, we can't give personal financial advice, but Akhil, Cornish property, Cornish land, is something that has gotten a little bit of airtime. It wasn't just due to the international event that was hosted there recently, but with folks who were born there being sort of driven out due to the gentrification of property prices and having to live elsewhere. It reminded me a lot of where folks in Hong Kong would actually be living on the mainland because they could no longer afford the house prices in Hong Kong. Any thoughts on Cornish property in general? Bullish, bearish?
No, not really. I don't have any thoughts at all. I mean, it seems to be the place that people want to be, but I think they're bringing in restrictions on various things that might continue, which might affect it. I can't sort of speak particularly intelligently about it. All I'd say is that it seems to be the place that people want to be. So if you're looking to sell into a rising market, you don't have to try and get the absolute peak in anything.
Right. Well, we are getting on a little bit for time, so I think we should be wrapping up soon. I do thank everyone for the questions we've got. Robin asked, "Can't we just invade France when we run out of land?" Well, Robin, I certainly
think we've tried that.
Yeah.
Isn't that a running theme in English history?
Well, maybe that's what we should be looking forward to at the end of this cycle. We've got that on the horizon, perhaps. One thing I would like to close with, Akhil, just for a bit of fun, is our long-short segment. So, of course, while we're not giving personal financial advice, we do like to take a look at recent events that have developed in the markets and what our guests feel they are bullish or bearish on. What would be something they were long, one thing that they were short? So, Akhil, could you give us your long and your short, please?
I mean, I think I've probably talked about quite a lot of them. So, real estate, banking stocks. You tend to find that emerging markets tend to do quite well in the second half of the cycle, particularly because the dollar tends to weaken. If the dollar's weakening, that means the euro is going up. So the Dow or the S&P 500 tends to outperform the Nasdaq. So long the S&P, not actually short the Nasdaq, but in relative terms. Long industrial metals, short gold, for the same reasons. Yes, Joseph, the emerging markets does need a weaker dollar, and I think we will see a weaker dollar for most of the second half of the cycle. Short bonds, so you will generally see a process of rising inflation. I'm not talking about the immediate sort of short term. I mean, once opening kind of comes up, you might see some headline inflation numbers come down, but it will be generally rising inflation as there's more and more bank money created against property. And so that will be very bad for bonds. So short bonds. Long art, classic art.
The masters are making a comeback, are they?
Well, I don't know. I mean, there's people throw money at all sorts of things, so it probably doesn't really matter. just find something.
Very good. And just a couple of last questions I think that we could take before we sign off for this evening. Michael asked a very good question. Could you explain the Japanese market in terms of the cycle? The market's never exceeded to date the 1989 high. And as far as I know, that was the peak of the Tokyo land prices as well.
Yeah.
So, as you were saying earlier in the show, the Imperial Palace, the land beneath it was worth more than the state of California once upon a time during the peak of their cycle. But things have never recovered to the same heights that they did back then. Why is that, Akhil? And is Japan an exception to the rule, or is this just because it was so extreme that things just haven't managed to get back there?
No, Japan's not an exception to the rule. They just had such a crazy boom that they had such a massive bust that it took them pretty much the entire next cycle to sort out. And ironically, The Economist published an article on 11th of October 2007 which said the Japanese property market has had a good 2 years. It's made a comeback, which was the date at which the Dow peaked before the financial crisis. So it did have a cycle of sorts. It was really recovering from, firstly, the crash of the early 90s and then the East Asian financial crisis in the late 90s. Japan has somewhat demographic headwinds, but I don't really see that being a problem. I think Japan will have a pretty strong second half of the cycle, largely because a lot of its companies will benefit from new technology, robotics, AI, and so on, which are really going to power the economy of the 21st century. So I think Japan will be quite well placed. I don't ever see, though, because of demographics and because of the experience of the early 90s, that the Imperial Palace will ever again be worth the state of California. It is possible for economies to learn certain lessons, and I think that was a real trauma. So it will influence Japan for quite a long time to come.
Maybe Hawaii, the state of Hawaii. I think
Japan.
California.
Interesting. Japan bought up a lot of Hawaii in the late 80s. A lot of the buildings, the hotels, and so on were done by Japanese companies.
Yeah, there's an interesting trend of that when it came to mergers and acquisitions, where you got all of these British firms and British real estate that was bought by the Japanese, and then now that we're in, especially in the 2010s, we just saw that again, except with the nouveau riche Chinese billionaires coming over and buying lots of these things. It will be very interesting to see how that changes over time. One last question, I think. Let's see. Oh, this is a very interesting one from Bernie here. High altitude ski resort properties, potential rising market due to increasing climate change affecting low level locations. Any thoughts on that, Akhil? Any ski insights?
Well, I can't talk specifically about skis, but the point is well made. You actually saw something like this in some of the low-lying cities in America that the properties along the coast were the places to be once upon a time, but as people became more and more worried about climate change, they started moving further up into the higher parts of the cities, and which were typically areas where lower income households were. And so now lower income households are moving further and closer to the sea. So you are seeing elements of that coming out.
Yeah, I guess that'll be something something further to look forward to, I guess, or to watch out for. Look forward to is the wrong phrase, as we get further along this, because I guess that will just increase the kind of disparity between the more expensive and more valuable land and the less valuable land. But Akhil, I think we shall tie it off for this evening. Thank you so much for joining us. It has been a great episode 28. Just before we sign off, Akhil, for everybody who has been watching, who has thoroughly enjoyed your analysis, where can they find out more about your work, and tell us a bit about what's going on at Property Share Market Economics?
Yeah, so that's the place to find out more about what we write about. So you can sign up for a free blog. We've got a couple of different types of publications you can sign up to if you wanted to delve into things in a bit more detail, and you can do so on a trial basis. So you'd be more than welcome to. So the address is www.propertysharemarketeconomics.com. Our main subscribers get an annual forecast of the Dow, the FTSE, the Australian All Ords, and the NASDAQ. We provide regular updates. We show them our indicators, where we are in the cycle. And we, I think really spend a lot of time trying to help people understand how to read events in the context of the cycle. Because one thing that is very clear is that there will be a repeat of the cycle. And it's we like clockwork as well.
Well, there you have it, folks. There should be a link to Property Share Market Economics in the description of this episode. And also, Akhil, you are on Twitter, is that correct? What's your @ handle? I can't remember.
It's Akhil G. Patel.
There you have it, folks. And indeed, Akhil does have a book coming out in the near future. I've been lucky enough to be privy to some of the pre-publication work, and Akhil is very humble. He won't brag about it, but it is very good material indeed. So when Akhil does release the book, we'll hopefully have another one of these episodes, and we'll be able to go over some of it and some further insights into the cycle as we go through the 2020s. But Akhil, thanks so much for joining me.
Thank you for having me.